Hello, students. So today we are going to see the topic about Garner versus Murray rule, which is a most important concept in dissolution of firm. So when a firm dissolves, there are various reasons of dissolution of firm, if you see. So one of the reasons is that if a partner becomes insolvent, in that situation, what is the solution for dissolution of firm? So, in Garner versus Murray case, there was a special rule laid out for the purpose in which there is a loss incurred in a firm uh, during dissolution of firm because that partner is insolvent. So let's see this concept in detail. What is Garner versus Murray? So before we are proceeding to the topic, first we should be clear with the term what is insolvent. So a person is referred to as insolvent when their liabilities exceeds their assets. So in a simpler sense, we say he's not able to pay back his debts. So he may be called as insolvent. So let's see what does that term means in that case of Garner versus Murray. If the partner becomes insolvent, he is unable to pay back the amount due to him. The amount not paid is a capital loss which should be borne by the solvent partner in the ratio of their capital standing in the balance sheet on the date of dissolution of the firm. So here, the insolvent partner who's not able to pay back his debt, who's declared to be insolvent, are not able to pay back his losses to the firm. So the loss due to his insolvency was borne by the other partners who is solvent. And in what ratio they're going to bear that loss is that capital standing in the balance sheet on the date of dissolution of the firm. So we should just keenly see this particular terms in this thing is that capital loss which is borne by the solvent partner should be taken in the ratio of capital standing. So here comes what is the judgment is all about. So the first, the solvent partner should bring in cash equal to their respective shares of the loss on realization. So the first thing is that they have to bring some cash. But when we speak practically, they are not actually bringing in cash, but we will make a notional adjustment in a such a way that the cash which they need to bring is adjusted against their settlements towards the final end of the dissolution. So actually the cash which is being accounted is being set off with the settlement they need to get back from the company. So in other sense, we say it's a notional adjustment we are making for it. And next thing is that the loss due to insolvency of partner should be divided among the other partners in the ratio of capitals then standing. So in what ratios they are going to share? They're going to share in the ratio of capital which is standing just before the dissolution of firm. So let's see when this rule does not applicable. So this rule is applicable wherever there is insolvency of partner in the partnership firm and they're going for dissolution. But it is not applicable in a place where all the partners of the firm are insolvent. So we say Garner versus Murray rule shall not apply when all the partners of the firm become insolvent. So let's understand this real scenario with this practical problem in it. So the following is the balance sheet of ABC on March 31, 2012. So if you see here, there is a balance sheet of the firm having a partner, three partners, A, B, C. So the liabilities side listed with few items of creditors, general reserves, and capital accounts of A and B. And if you see the asset side, it has been listed with cash, sundry debtors, stock, furniture, machinery, and capital of C overdrawn. So if you see, C is already having a negative balance over his capital account. And C is insolvent, but his estate pays rupees 2,000. It is decided to wind up the partnership. The asset realized was follows. Sundry debtors 7,500, stock 16,000, furniture 7,000, machinery 14,000. The cost of winding up came up to 2,500. Give the accounts to close the books of the firm if the capitals are fixed and if the capitals are fluctuating. So let's see in both the scenarios what would be the effect of Garner versus Murray rule and how they're going to settle their accounts in dissolution. So let's see. The first step towards dissolution of firm solution is we are going to compute realization account. So realization account, the purpose of it is they just want to know what they finally realized over the assets and liabilities of the company and how they're going to use those amount towards their settlement of accounts. So the first step is that if you see the realization debit side, the sundry assets are being listed. Whatever there in the balance sheet except the cash balance, everything is listed here. Sundry data, stock, furniture, and machinery is being debited to sundry assets. And if you see the credit side, whatever assets which is being realized for the amounts has been listed. So how much of value the each and every assets are being listed. So that has been on the credit side. So, and also we have paid some 2,500 towards cash expenses. So that's why it is being debited again in realization. And finally, we are supposed to find out the balancing figure, which happens to be on the credit side, loss transferred. So these laws are being transferred to all the partners in their profit sharing ratio. If you see this question, this A, B, C, the partners are sharing their profits equally. So we are just right now sharing that 18,000 in equal manner, 6,000, 6,000, 6,000 for partner A, B, and C. And next step, after we are done with this realization account, is that we have to move forward with the creditor settlement. So always the creditors are settled with whatever funds which is available in the company first. So the creditors balance already stated in the balance sheet is 20,000, which has been opening balance in that ledger, and we are paying 20,000 to them and settlement account. So we are making the entry of to cash 20,000. And next we proceed with capital accounts. So when you come up with the capital accounts, so here we had a 3-columnar ledger, which is giving the amounts of 3 partners, A, B, and C. So the first step is that we should do with the opening balance, and we are going to distribute the reserves which is there in the balance sheet, which is general reserve, that is being distributed equally. And the next part is that we have to transfer the realization loss, which we have computed in the previous ledger, which is 6,000, 6,000, 6,000. You can see that it has been debited in the left side. And since the C is having the negative capital, the opening balance appears on the debit side of the capital account. And when it comes to the settlement part, so here when you see by cash 2,000 is being paid by B. What is that 2,000? He is actually paying 2,000 towards the with his personal estates. So that's why 2,000 is being on the credit side of the capital account, and by cash 6,000, 6,000 is there. It's nothing but we saw the first effect of Garner versus Murray. Whatever loss which has been suffered by the company due to insolvency of a partner is borne by whom? Is borne by the solvent partners. Since C is insolvent in this company, only A and B are solvent partners. So that's why that A and B partners are supposed to bring in 6,000 cash for the realization loss which has been accounted here. So when you see the realization loss is 6,000, 6,000. So those amount has been asked to bring as a cash by those partners A and B who are insolvent. And next, when you see the left side of your ledger capital account, 8,000, it's nothing but the balancing figure of 8,000 of C's ledger when you see. So C's ledger, you have a balancing figure of 8,000. So that 8,000 is a loss which is to be borne by whom? It's nothing but solvent partners, A and B. So here if you see, they have accounted in the ratio of 25:15. What is that 25:15? It's nothing but their capitals, 25,000, 15,000. That has been gone as a ratio. So here it comes, how it being computed 5,000 and 3,000. And when you see here, so this 5,000 and 3,000 is again transferred. It's a contra entry. So it has been transferred to the debit side of the ledger. So on a whole, this capital account shows right now the settlement parts of the partners. So A and B having a cash settlement of 25,000 and 75,000 at the end of this ledger. So they are supposed to get money, final amount of 25 and 17,000 from the company. So when it comes to cash book, so already we have opening balance of 6,000 in this balance sheet. So we are starting this ledger based on that, and we are proceeding further with accounting it. So when you see to realization account, the assets realized for 44,500, and if you see C's capital, he's paying up 2,000, and to A's capital and B's capital, they are bringing in 6,000, 6,000 for realization loss. And if you see the right side, realization expenses, we are paid 2,500. For creditors, we are making settlement 20,000. And finally, A and B are being settled up with 25,000 and 17,000. And the total of the cash book gets self-balanced, and there is nothing to be bothered for balancing figure. So this is how we will get the final accounts, that is the statement of accounts of dissolution of firm. So if you see, so this is all about fixed capital method. Let's see how this is going to reflect in a fluctuating capital method. So if you see this fluctuating capital method, same thing. We are going to see realization is account will be the same as if we done for fixed capital, but there is a change in cash book alone in this fluctuating capital. Is here is that if you see, we started with the opening balance and we wrote the assets realized, and we accounted all the receipts we got from the partners. So C is giving up 2,000 of assert, A and B is giving 6,000, 6,000 each for the realization loss, same as appeared before. And if you see the right side, by realization expenses 2,500, and by creditors 20,000, and A settlement and B settlement. So if you see here, what's the difference we are just facing here? Let's see the capital account, what would be the difference. So let's if you see, the only difference is that the ratio of capital sharing ratio of the capital loss. So if you see, C's 8,000 loss has been beared by A and B in a capital ratio. So in previous fixed capital method, it's just 25:50. But it is different here. What is the difference? See the working note which is below here. So here capital ratio is computed in this way. Capital plus reserve. Capital is 25,000, general reserve is 5,000. And for B it is 15,000, general reserve is 5,000. So if you see, the ratio is being arrived based on these figures, which includes reserves. Okay, so that's why the ratio is 30:20. So when we apportion this 8,000 in this ratio, we get different amount of 4,800 and 3,200. So this is the only difference between the fixed and fluctuating capital method. So if you see in the fixed capital method, the capitals alone are being considered for the ratio. But in the fluctuating capital method, not only the capital which is outstanding there, but also any reserves which is outstanding also been included in it, and the ratio has been computed on the overall amount. So that's why we get a difference of amount. And when we proceed the same change to the capital, that is a cash book of the fluctuating capital method, since the settlement values varies, you will get different values of balancing the amount, and we are getting the ledger of cash book self-balanced out of it. So this is the whole thing about how Garner versus Murray rule is being applied towards the problems of the dissolution of firm. So the first, I'm just going to summarize all the things which we have done so far. Number one, the realization loss is being brought in as a cash by the solvent partners. And number two is that whatever deficiency or the loss which is being occurred due to the insolvency of the partner is borne by the other solvent partners of the firm. In what ratio? In the capital ratio, which has been just outstanding before the dissolution of the firm. So these are the two main effects which impacts the statement of accounts in dissolution of the firm. Hope the explanations are more convincing to you and more understandable to you. I'm sure that I just made a justification for the thing. So thank you all. Post me your doubts and clarifications if required.